When accounting for business combinations, it's important that we identify what exactly was acquired through the business transaction, and then what was the consideration that was transferred in exchange. The calculation that we use this information in is called the acquisition analysis. The accounting standard requires the investor or the acquirer to record the assets and liabilities, or the assets acquired and the liabilities assumed, to be valued at fair value. So when looking at what exactly was acquired, we need to consider whether the assets that we have acquired through this business combination has been valued at fair value, and if there's any liabilities assumed, whether that is also stated at fair value. Prior to recognizing the identifiable assets and the liabilities assumed, two conditions have to be met. First of all, the assets and liabilities need to meet the definition in the conceptual framework for assets and liabilities, specifically regarding the treatment of contingent liabilities. The only real contingent liabilities are recorded, and no expected future costs can be included. So we need to measure or the assets that we've acquired against the definition for assets and the liabilities against the definition for liabilities. Further to that, the items acquired or assumed must be part of the business acquired and not be part of a separate business transaction. We then further need to study the question to see what we've paid for this business transaction. Now, this can include share-based payment where we issue shares. It can involve cash that we transfer to enable the acquiree to settle certain of his claims, and it can also be maybe an asset swap where we give assets, physical assets, in exchange for the assets that we've acquired. Once again, if you study the question closely, we can identify the consideration transferred. Now let's look at some of the tutorial questions and then just see whether we can identify what was acquired and the consideration transferred. In question 1011, we saw that New Starfish Limited acquired Tuna Limited, albeit the operations of Tuna Limited, whereafter Tuna Limited has been liquidated. Now, in terms of what exactly was acquired, we refer to this section in the question, Acquisition of Tuna Limited, where we read that New Starfish Limited is to acquire all of the assets of Tuna Limited except for cash. The assets of Tuna Limited are recorded at their fair value except some of the assets identified in the question. Now, here we can see that New Starfish Limited only acquires assets of Tuna Limited, and no liabilities are assumed by them. So if we look at the information given in the statements of financial position, we can then see that the cash is excluded because that's used by Tuna in settling their claims when they liquidate. But the assets that we do acquire is accounts receivable, inventory, plant and equipment, and an investment in another company. And now we have to consider whether these assets are recorded at fair value or whether the carrying amount in the accounting records is equal to fair value. If it's not the case, we have to include it at fair value in our journal entries. So in the acquisition analysis as well, at fair value. Now let's read further to see whether we can identify the consideration transferred. Now, after they've given us information on the assets that were acquired, the question states that in exchange, the A-class shareholders are to receive 1/7% debenture in New Starfish Limited for every share held in Tuna Limited. So that's debentures in exchange for the shares that were held. Then the fair value of each debenture is $3.50. So that helps us to calculate the consideration transferred. The B-class shareholders are to receive 2 shares in New Starfish Limited for every 3 shares held. The fair value of each of these are $2.70. Additionally, they will provide Tuna Limited with sufficient cash additional to that already held. So we have to consider the cash that we've saw in the statement of financial position to enable Tuna Limited to pay its liabilities. The outstanding debentures are to be redeemed at 10%. So this now gives us information on the liabilities of Tuna so that we see how much cash we actually have to include for this transaction. Further to that, there's annual leave entitlements of $16,200 and the expected liquidation cost of $5,000 have not been recognized. It's an unrecorded liability. Costs associated with undertaking the acquisition amounted to $1,600. Now that cost does not relate to the consideration, calculating the consideration transferred. It's a cost incurred by New Starfish Limited and it will be recorded as such in their accounting records. So using the information to prepare our acquisition analysis, the acquisition analysis then consists of 2 components. First of all, identifying the net fair value of the identifiable assets and liabilities assumed. So in this question, if we said it's only assets that we've acquired, they have to be stated at fair value. Then we'll include our accounts receivable at $56,000, our inventory, plant and equipment, and the shares, the investment, which the fair value was given separately. So that gives us a total of $257,700. So that is the fair value of the net assets acquired. Looking at the consideration transferred then, first of all, it's the exchange of debentures for every share held for the A-class shareholders. So if I can just shareholders, they will receive, let's first see, there is the value of the A-class shareholding is $40,000. It's $2 per share, so it means it's 20,000 shares, and it's on a 1-for-1 basis. So the A-class shareholders will receive debentures to the value of 20,000 times the fair value of $3.50, $70,000. So that's one part of the consideration transferred. The second, we look at the B-class shareholders. They receive 2 shares in New Starfish for every 3 shares held. So looking once again at statement of financial position, B-class shareholders issued at $1 each, so it's 60,000 shares, and it's on a relation in the relationship for every 3 held, they will receive 2. So it's 40,000 shares in New Starfish Limited, and the fair value of the shares were $2.70 at that stage, resulting in an amount of 108,000. So that deals with the shares, the share capital and the shares held in Tuna Limited. Further to that, we see that they also provide Tuna with sufficient cash to settle their liabilities. So we need to consider the liabilities that exist. So let's make that green to make it easy to understand. So the outstanding debentures are to be redeemed at a 10% premium. The debentures, the face value is $30,000. So plus the premium, the debentures, they need $33,000 in total to settle the claim of the debentures. Accounts payable is $31,000. Mortgage loan $21,500. Then unrecorded liabilities is the expected liquidation cost of $5,000, and then also the annual leave entitlement of $16,200, which has not been recorded in their statement of financial position. So it's the $16,200, the $5,000 of the liquidation cost, and then the other two creditors there at the top, the accounts payable and the mortgage loan. And that gives us a total amount. If we add all of these and the top ones here together, it gives us an amount of $106,700. So that is the total cash required. However, they do sit with $20,000 in their bank account, so we only have to provide them with $86,700 cash. So therefore, our consideration transferred consists of the cash of $86,700, the debentures to the A-class shareholders, and the shares to the B-class shareholders. And that total is $264,700. So that's the second part of our acquisition analysis, comparing that to the assets that we've acquired valued at $257,700. We can then continue to do our goodwill calculation. Let's quickly look at question 1014, just trying to identify what exactly was acquired. In this question, it stated that it was agreed that it would be mutually advantageous for Saratoga to specialize in manufacturing and for Kingfish to handle other operations or parts of the business. Accordingly, Kingfish Limited sold part of its assets to Saratoga. The question further states the identifiable assets acquired had the following fair value. So there we see what formed part of the assets acquired for this business transaction. Inventory, land and building, plant and machinery. And that's all you include as part of the identifiable assets acquired, valued at fair value. Now let's look at the consideration transferred. The acquisition was satisfied by the issue of 40,000 A ordinary shares fully paid in Saratoga Limited. So that was a share-based payment that we issued shares in exchange for the assets we've acquired. And then the question required us to consider two different scenarios if the fair value was $2 and $2.20. Reading through question 1012, let's see if we can identify the assets acquired in this business transaction. So take some time to read through the background, and then it says Ling Limited is to acquire all of the assets except cash, delivery trucks and motor vehicles of Mwang Limited, and will assume all of the liabilities except accounts payable. Now looking at the statement of financial position, we can then see the identifiable assets acquired will include accounts receivable, freehold land, buildings, cultivation equipment, and irrigation equipment. Because it's stated they acquired all the assets except the cash and the delivery trucks and motor vehicles. Further to that, they've assumed all the liabilities except accounts payable. So looking at the liability section of the statement, we see that it basically constitutes 3 loans that were assumed by them and not the accounts payable. You then further have to read through the question to see what the fair values of these items were for inclusion in your acquisition analysis. We can also use this question just to look at calculating the consideration transferred. So the question states that in return, Ling will give the shareholders of Mo Wang a block of vacant land, 2 delivery vehicles, and sufficient additional cash to enable the company to pay off the accounts payable and the liquidation cost of 1,500. So this is an unrecorded liability. Then further to that, they give us some of the fair value amounts. So we can see that the freehold land that was given to them as part of the consideration, the fair value is $120,000. The delivery trucks that we gave to them as part of the settlement is the fair value is $28,000. Then also we were required to give them sufficient cash to cover their accounts payable plus the unrecorded liability for liquidation expenses. So that's a total of $25,000 less the cash that they've got in their bank. So we also had to give them cash of $23,000. So you add all those together to get to the consideration transferred.